Most people do not lose money because the world becomes dangerous. They lose money because they hand their future to a machine. They never bothered to understand. The machine is not the stock market. The machine is the way fear, headlines, salary habits, inflation, and bad timing work together to separate ordinary people from ownership. You think the danger is oil. You think the danger is geopolitics. You think the danger is some ugly payroll number, some television anchor raising his voice, some chart with red candles and dramatic music. That is not the real danger. The real danger is that every time the machine gets loud, you become obedient, you freeze, you wait, you move to cash and call it discipline. You stare at uncertainty and call it prudence. You let a temporary storm convince you to abandon a long-term engine. And then, when the machine quiets down and the opportunity is already expensive again, you come back begging for the leftovers. I have watched this pattern my entire life. The crowd never pays the highest price when things look bad. The crowd pays the highest price when the fear is already gone. That is why ordinary investors are almost always late. They do not buy value. They rent confidence from the media. And confidence is always most expensive at the wrong moment. So let me be blunt. If you are letting oil headlines, recession chatter, and political theater push you out of ownership right now, you are not protecting yourself. You are volunteering to become raw material for the machine. The machine loves people who confuse noise with signal. It loves workers who save in paper, hesitate in panic, and buy only after a rally makes them feel socially safe again. It loves people who need permission to act. And if you do not understand how the machine really works, you will spend your whole life feeding it with your labor while someone else owns the gears. I do not invest that way. I never built wealth by asking whether the crowd felt comfortable. I built wealth by asking a colder question. What is the machine actually doing beneath the noise? That is the question that matters now. Everybody is talking about oil prices as if one spike in energy means the whole economic machine is about to tear itself apart. Everybody is throwing around stagflation as if saying the word often enough makes it probable. Everybody is staring at unemployment prints and geopolitical headlines as if history began this week. That is how fear works. Fear takes a low probability event, gives it a microphone and makes it sound like destiny. But the machine does not run on emotion. It runs on conditions. And the first thing I want you to understand is that true stagflation is not some candy people should be tossing around every time gasoline gets expensive. It is a very specific malfunction. It is ugly because it combines two things that do not normally like to live together: high inflation and weak employment, expensive life and shrinking opportunity. That combination is toxic. But toxic does not mean common. That alone should tell you something important. The machine can scare you with a headline every month. History does not honor every headline. And when you go deeper, the machine becomes even more selective for oil panic to mutate into a genuine stagflation spiral. Several gears have to lock together at the same time. You need a major oil shock, not a dramatic weekend. You need a sustained increase, not a short emotional spike. You need underlying macro weakness that is broad, not one soft data point that people parade around like a funeral procession. And you usually need a central bank tightening into the problem, forcing the machine to grind harder when the economy is already under stress. That matters because markets do not just react to facts. Markets react to imagined chains of consequence. The public sees one scary gear moving and immediately assumes the entire machine is doomed. That is why fear gets overpriced. Now, I am not telling you that nothing can go wrong. That would be foolish. I am telling you something much more useful. You do not need a fantasy world with no risk in order to make rational money. You only need the discipline to stop treating the worst story on television like the base case. This is where ordinary people get damaged, not by reality first, but by anticipation. They let the machine charge them what I call the headline tax. The headline tax is what you pay when frightening narratives push you into the wrong action before the evidence is complete. It is the tax you pay when you sell good assets, because the media discovered a new adjective. It is the tax you pay when you sit in cash while the ownership class quietly accumulates. It is the tax you pay when you confuse emotional relief with financial progress. And once you have paid that tax enough times, you start calling paralysis a strategy. I refuse to do that. I would rather study probabilities than rent panic. I would rather prepare for multiple outcomes than marry one scary headline. I would rather own a machine with dents than cling to paper that looks clean while it decays. Because that is the second thing you need to understand. Cash is not neutral over long periods. Cash is a machine too. It is a slow extraction machine. People think cash is where risk goes to die. Nonsense. Cash is where purchasing power goes to get quietly dismantled. If all you do with your life is work, collect a paycheck, stack the dollars, and admire the number on the screen, the machine smiles at you. It smiles because your money is standing still while prices keep moving. It smiles because your labor happened in real time, but your savings are trapped in a shrinking claim. It smiles because you are measuring safety in nominal dollars, while your actual life gets more expensive. That is why I do not merely ask whether the stock market is risky. Everything is risky. I ask which machine punishes you more with certainty. A volatile ownership machine that rewards patience and punishes weak behavior, or a quiet cash machine that guarantees erosion while pretending to be polite. For the middle class, the answer should be obvious. The rich can survive a lot of mistakes because they own productive assets, private businesses, land, brands, and equity. The middle class feels inflation in the grocery store, at the pump, in rent, insurance, tuition, and medical costs. They feel it because they are close enough to their paycheck that every hidden tax lands directly on the skin. That is why a savings account is not a complete strategy. It is a parking space. Parking spaces have a purpose. They are not where you build a life. Now, once people realize cash is not the refuge they imagined, they usually make the next mistake. They decide they are going to outsmart the machine by timing everything. They will sell the top, buy the bottom, and dance between greed and fear with perfect elegance. That fantasy has emptied more pockets than bad businesses. Why? Because timing is not just a math problem, it is a psychological trap. The machine does not beat you only with price. It beats you with hesitation. You sell because you feel clever. The market rises and you wait because you want a better entry. It rises again and you tell yourself you are disciplined. Then you buy higher because now you need emotional permission. Then the market dips and you panic because you entered for social reasons, not strategic reasons. That cycle can ruin a person for decades. I call it the exit penalty. The hardest part of leaving the market is not the selling. It is the re-entry. Once you are outside the machine, every upward move feels insulting. Every dip feels like a trap. Every decision gets heavier because your ego is now involved. That is why gamblers underperform even in a system that trends upward most of the time. The machine rewards consistency. It punishes theatrical intelligence. So what do I prefer? I prefer to automate rational behavior. I prefer a system that does not require me to perform magic at the exact moment. Fear is loudest. I prefer broad ownership, regular buying, and aggressive calm when the machine offers discounts. Call it dollar cost averaging if you want. I think of it more simply. Feed the right machine whether the crowd applauds or not. And when the crowd is panicking, I do not stop feeding it. I often increase the feed, because panic is not always a stop sign. Quite often, panic is the machine offering you a better price for the same productive asset. This is the part many people still resist, because they want investing to feel fair in the short run. It will not. The machine is not here to comfort you. It is here to transfer assets from the emotionally fragile to the behaviorally disciplined. That is why you must choose your identity early. Are you a spectator of the machine or an owner inside it? A worker who reacts or an allocator who decides? A person collecting wages and praying, or a person buying productive claims when others are too nervous to act? Most people never ask the question cleanly. They tell themselves they are long-term investors, but what they really mean is they enjoy being long-term when prices rise. A real owner does not need a cheerful environment. A real owner needs a clear framework, and the framework now is more powerful than people realize, because beneath the oil panic and recession chatter, another machine is already being assembled. A much larger one, a machine that is going to reshape capital spending, infrastructure, corporate power, labor, software, defense, logistics, and the economics of intelligence itself. I am talking about artificial intelligence, but not in the childish way people usually talk about it. Most people hear AI and think about the glamorous layer. They think about the chatbot, the app, the viral product, the consumer excitement. That is fine for dinner conversation. It is not how serious money is made. When a gold rush starts, the crowd runs toward the glitter. The durable fortunes often go to the people selling the picks, the shovels, the rails, the fuel, and the replacement parts. That has always been the pattern. The public wants the story. I want the machine behind the story. That is why I have spent far more time thinking about choke points than mascots. If a giant new industrial wave is forming, the first question is not which brand feels exciting. The first question is where the machine can choke. Where does demand exceed capacity? Where are the hard constraints? Where are the bottlenecks that cannot be wished away with optimism? For AI, many people finally woke up to the first obvious constraint, which is power. These systems require enormous electricity, cooling, and physical infrastructure. That was not a side issue. That was the machine reminding everybody that intelligence at scale is still built in the real world. It needs energy, equipment, and industrial coordination. But once the crowd catches up to one choke point, the next one begins to matter more. And that is where I believe a great deal of money will be made from here. The new bottleneck is memory, not in the sentimental sense, in the hard industrial sense. Context, capacity, bandwidth, the physical and architectural ability to let these systems hold more state, do more work, and support more advanced behavior. Now, if you are not technical, good. You do not need to become a semiconductor engineer to understand the investment logic. You only need to understand how machines fail when one component cannot keep up with the rest. You can build faster processors. You can design smarter models. You can spend fortunes on software talent. But if the machine needs more memory, more context, more high bandwidth support, and the supply base is concentrated, then the bottleneck becomes investable. That is how adults think about waves like this, not by chasing the prettiest chart, by mapping the pressure points. I want you to see how different this is from ordinary speculation. Speculation says, I think this theme sounds big. Analysis says, I see where the machine will strain, and I want ownership at the strain point. That is a different level of thinking, and it is the level you need if you want to escape the worker trap. The worker trap is simple. You sell your time into one machine and spend the proceeds in another. You work for wages. You store the wages in low-yield paper. You absorb inflation. You buy expensive certainty after the panic passes, and then you wonder why freedom keeps moving farther away. Ownership breaks that pattern. Ownership says, I do not need to predict every twist of politics. I do not need to know next month's headline. I do not need perfect timing. I need a rational relationship to productive machines. I need broad exposure to the great compounding machine of business. I need the temperament to add when the crowd subtracts. And when a new industrial build-out appears, I need to identify the unglamorous choke points that the crowd will underprice until the evidence becomes too obvious to ignore. That is where the current opportunity sits. Not in pretending the world is safe, not in denying that volatility exists, not in worshiping one ticker as if it were a religion. It sits in recognizing that the market has probably overpaid for fear while underpricing the next stage of the AI build-out. That next stage is not just software fantasy. It is industrial reality, memory, power, cooling, fabrication, foundries, packaging, and the entire supply chain of intelligence. Now, let me be very precise here. I am not arguing that every memory stock will move in a straight line. Machines do not work that way. Semiconductor markets are cyclical, supply expands, demand pauses, inventories swing, valuations re-rate. If you need a perfectly calm ride, you are in the wrong vehicle. But cyclical does not mean structurally unimportant. In fact, some of the best opportunities come when a cyclical industry becomes the temporary bottleneck for a much larger secular machine. That is exactly why so many people miss it. They stare at the old cycle and fail to notice the new context. They see memory and think commoditized, volatile, dangerous. They do not stop to ask whether the machine being built above it has changed the economics below it. That question matters, because if demand for context, bandwidth, and AI infrastructure compounds faster than new supply can be built, the old prejudice becomes your opportunity. That is how money is made. Not by memorizing jargon, by noticing when the crowd is using yesterday's map for tomorrow's machine. This is also why I do not get excited by the endless debate over whether the current macro scare will produce a clean textbook recession, a messy slowdown, or another temporary washout that television will treat like the apocalypse. Those details matter for traders. For owners, they matter less than people think. Why? Because if you are building a portfolio for the next decade, you are not being asked to solve a riddle for the next 10 days. You are being asked whether you understand the machine well enough to keep buying through fear. That is an identity question, not a headline question, and identity always compounds before money does. If your identity is built around comfort, you will always buy too late. If your identity is built around appearances, you will want social proof before you act. If your identity is built around control, you will love cash until you realize inflation has been controlling you the whole time. If your identity is built around ownership, patience, and selective aggression, then sell-offs become information. They do not become orders. That is how I would urge you to think now. Do not ask, how do I feel about the next few weeks? Ask, which machine am I feeding for the next 10 years? That question cuts through the clutter, because there are really only a few honest options. You can feed the fear machine and do what most people do. Scroll, worry, hide, wait for certainty, then arrive late. You can feed the cash machine, work hard, park the money, admire the balance, and let inflation hollow it out slowly while calling yourself conservative. You can feed the gambling machine, jump in and out, try to nail every top and bottom, and pay the exit penalty until your confidence is ruined. Or you can feed the ownership machine, broad market exposure, quality businesses, systematic buying, extra aggression when panic discounts the same productive assets you wanted all along. And inside that ownership machine, when a generational industrial build-out appears, you can tilt selectively toward the bottlenecks. Not because it sounds exciting, because the machine cannot move without them. That is the difference between narrative and structure. Narrative is what the crowd repeats. Structure is what drives returns. Oil panic is narrative. Fed gossip is narrative. Daily sentiment is narrative. The machine underneath AI infrastructure is structure. Memory demand is structure. Power demand is structure. Foundry constraints are structure. The concentrated control of key semiconductor categories is structure. When you learn to separate the two, you stop being easy prey. You stop selling the future to buy emotional relief. You stop treating cash like morality. You stop needing someone on television to make you feel permitted to own productive things. And that shift is worth more than any stock tip, because once you understand the machine, you can apply the logic again and again. You can apply it to markets, to business, to career choices, to debt, to spending, to who gets your time and who gets your capital. You can start asking a more dangerous question than what is hot. You can ask, where's the choke point? That question will make you rich more often than cleverness will. Where is the choke point in your own life? Is it your spending, your lack of savings, your dependence on one paycheck, your inability to think beyond the next quarter, your addiction to social proof, your reflex to stop buying? When prices get more attractive, do not miss the irony. A great many people can understand the idea of a bottleneck in AI faster than they can recognize the bottleneck in their own behavior. But both matter. A portfolio built for freedom needs two forms of discipline: capital discipline and psychological discipline. Capital discipline tells you what to own. Psychological discipline tells you whether you will still own it when fear gets expensive. Without the second one, the first one does not pay. That is why the real battle is never just valuation. It is self-command. You cannot build wealth if every scary week can hijack your plan. You cannot compound if every dip becomes a character test you fail. You cannot become an owner while still thinking like a temporary renter of confidence. And this is where I want to end. Not with a forecast, with a test. Because that is what moments like this really are. They are not only market events, they are filters. The machine is asking you a hard question. Do you want emotional shelter, or do you want long-term control? Do you want the appearance of safety? Or do you want ownership of productive assets through discomfort? Do you want to be the person who studies the machine, feeds it rationally, and buys the choke points while the crowd is busy fearing smoke? Or do you want to stay what the system prefers, a well-behaved worker who hands over time, hoards shrinking dollars, and waits for permission until the opportunity is gone? That is the door in front of you. Behind one side is the life most people choose: more labor, more caution, more delay, more inflation, more dependence, more regret dressed up as responsibility. Behind the other side is not certainty. Do not ask for certainty. Adults are not paid for certainty. They are paid for judgment. On the other side is a different arrangement with the machine. You own more, you react less, you let volatility do its work without handing it authority over your decisions. You use fear as a pricing event, not a command. You keep cash as a tool, not a religion. You build around productive assets, broad exposure, and selective bets on the choke points that the future cannot avoid. So choose carefully, because the machine will keep moving whether you understand it or not. It will keep transferring wealth from reaction to discipline, from spectators to owners, from people who need calm to people who can think. You can keep waiting for the headlines to bless your next move, or you can decide right now that you are done renting your future to fear. If you walk away from ownership because the world feels noisy, the machine will not pity you, it will invoice you. If you hide in paper and call it prudence, the machine will not argue with you, it will dilute you. If you chase rallies only after they become socially safe, the machine will not stop you. It will simply sell you back your courage at a premium. But if you can stand in front of the noise, see the gears underneath it, and act like an owner anyway, the machine changes character. It stops being your predator, it becomes your servant. And that is the threshold, not whether you can predict the next month, whether you are finally ready to stop living as fuel inside someone else's machine and start owning the one that compounds without asking anyone's permission.